Hi, everyone, and welcome to today's webinar, How Will Fixed Income TCA Adoption and Use Change Going Forward? My name is Audrey Blater, and I'm a senior analyst at Coalition Greenwich, an independent research and consultancy firm. Before I ask my panelists to introduce themselves, and we've got a great lineup for you today, I just want to go over some very basic housekeeping. First, this webinar will be recorded, so if you miss anything, you'll certainly have the opportunity to view it again at a later time. Additionally, we will run about 45 minutes or so, and that will allow for some Q&A at the end of the session. Please feel free to enter whatever questions you have in the provided area. And then lastly, if we don't get to your questions, you can certainly reach out to myself or our panelists separately after the webinar. So without further ado, I'd like to turn to my panel of experts and please ask them to introduce themselves.
Good morning, good afternoon. My name is Tom Melvin. I'm the head of Director of North American Credit Trading at Invesco, which encompasses high yield, investment grade, and emerging markets. Been at Invesco for about 5 years and trading fixed income securities for a little more than 25 years in total. So that makes for an old man with a fair amount of different market experience, and I'll pass it on. Thank you.
Hi, I'm Ross Walter. I'm the head of fixed income TCA and execution consulting at Vanguard. So that means that we have coverage of our FX trading, our derivatives trading, as well as all of our cash bond trading within Vanguard. My background, I come from the equities TCA space, and I've been leading our fixed income TCA group now for 3 years, I think.
Yeah, hi everyone. My name is Ravi Sawney, and I'm the head of trade automation and analytics here at Bloomberg. So we run a product and quant team that provides analytical and trade automation solutions cross-asset to price-taking buy-side community.
Fantastic. Welcome, everybody. I'm going to kick things off with a first topic. And that's going to speak to the TCA state of adoption. So hopefully you can see a slide that I've just brought up on my screen. So as you can see that, TCA practices in fixed income are really varied. So during a recent study, Coalition Greenwich gathered opinions from 111 buy-side firms to try to better understand trends in TCA relating to their fixed income portfolios. As you can see from the pie chart, participants are fairly optimistic about TCA, and maybe roughly half or so are employing those practices today. Then you see another 15% or so hope to do so at least at some point, which is very, very encouraging. So perhaps turning to our buy-side panelists first. I mean, Tom and Ross, what do you think why do you think the numbers shake out this way? Although the findings are pretty positive for TCA, as you can see in the chart, why is there a reluctance by almost 20% of participants and expressive concern over things like tools and data? And then, of course, we can even talk about the folks that don't even think there's a need for TCA for fixed income.
So yeah, at Vanguard, we definitely believe that there is a need for fixed income TCA. We would, I guess, fall firmly in that blue 50% of yes. However, I can certainly understand the hesitance, right? It is not as clearly defined as, say, the equities TCA problem, where we have a perfect consolidated tape to do the research that we want to do. It's a lot murky, and I would guess that some firms are sort of just waiting for the data and technology to shake out. That's not our, I guess, philosophy here. We want to have boots on the ground so that, as this space is developing, we're sort of at the forefront of it, or at least, in the mix. We do think that in the current state, there's plenty of things that can be done and plenty of data sources to do sort of meaningful research in the TCA space.
Yeah, I mean, to add to Ross's comments, I think the first hesitancy is just the nature of at least credit traders in terms of adopting new principles. It takes a while to start to encompass new functionality into roles and using new tools as quickly as the market is evolving. It still takes some breaking down of old habits to something that is potentially questioning execution, right? I mean, I think that has a lot to do with it, and looking back and retroactively kind of assessing each trader's what they've done successfully or unsuccessfully and how we can change that. I think the other part of that is, if you look at the Russell 2000 index and you spoke to an equity trader on the sell side and asked how many of those names you could get markets on, let's say on 3,000 to 5,000 shares, a nickel wide, that number would be 100%. If you look at the 1,900 names in the Bank of America ICE high yield index, I would guess to say maybe you could get 1 million up shares market in high yield on 300 names. So if you look at those numbers and then say, well, how can I be judged on 1,600 names that I potentially executed that I couldn't get a market on? How can we evaluate that? I think that's a question for credit traders, especially in times of volatility, which oftentimes leads to illiquidity.
And to bounce off of that, there are limits to, there are very well defined limits to certain asset classes, even within fixed income, right? We do not look at TCA outside of treasuries and credit at this point in time. Credit sort of being, as Tom said, right, that's sort of even stretching our limits as the data and technology stands now. So to move to, say, asset backs or mortgage-backed securities and munis, right, that sort of stuff is not on our radar currently.
Interesting. I mean, Ravi, obviously you have a different view into what people are doing. I'm curious why you think the numbers shake out this way, with about 50% using TCA for fixed income now, some wanting to do it and some saying there's no need, or I don't have the data or tools. How do you think about that?
Yeah, I think it's a positive result, right? I mean, the way I look at this is that, only 16% don't see the need for it, right? So you've got 84% that are either doing it, plan on doing it, or I guess are open to doing it if they can figure out the tools and the data part. Obviously, as Ross and Tom were alluding to, it's much harder to do TCA in fixed income than, say, listed equities. But I think it is definitely possible to put together a credible approach, especially for liquid cash, government and credit bonds. And I think there are the benefits beyond just doing your own kind of analysis and performance on your own desk, extend to kind of looking at the peer data as well, right? So looking at how you're doing versus your peers, and that's kind of like a powerful tool that I think, if you're doing TCA, you should, most clients will look at trying to contextualize their own performance versus their peers.
Yeah, great points. Maybe just shifting over a little bit, I'd like to show another chart so we can talk a little bit about what market participants are looking for when it comes to TCA adoption. And again, this is from the same study where we reached out to 111 buy-side professionals to ask them about what they're thinking in relation to fixed income, specifically to fixed income TCA. In this chart really speaks to the whys and the why nots of adoption that buy-side professionals might be thinking about when they consider using TCA or not using it. So you can see from the chart, the top reason for using it is for both a pre and post-trade tool used to model or forecast trades and to analyze trader or trading efficiency and effectiveness, which is really the use case for TCA more generally. But I think what's interesting is that of that 42%, you can see that 39% of that is really focused on this sort of post-trade type review. So the second bar down. And that's not surprising at all. I've been covering the topic of TCA for about 7 or 8 years now. And certainly, while there are a lot of people that want to see more pre-trade or real-time or in-trade analytics for the purpose of cost analysis, a lot of it is still sort of focused in this post-trade world. And then if you go further down the chart, you'll see that there's a call for using it for oversight or reporting, certainly venue analysis, and then other things like trade surveillance or more of the portfolio management type functions like portfolio management construction or alpha profiling or things like that. So assuming that adoption is being considered at some future point, I mean, how should firms think about setting up their TCA solution or choosing a provider based on sort of these needs and wants that we see on this chart in our findings? And happy to turn to our buy-side panelists first. Obviously, Ravi, would love to hear your opinion too.
So to me, the post-trade review to just judge the effectiveness against the benchmark, that's sort of like table stakes TCA, at least how we see it, right? The pre-trade stuff is just informed by that post-trade analysis. So obviously, hitting our benchmarks is a big thing at Vanguard, or not wildly missing them, especially for our index funds. So that's sort of where we start is that post-trade review. And we found that can be sort of very effective in changing trader habits and sort of informing trading strategies going forward.
Yeah, I think one of the difficult factors that is almost impossible to add into some type of TCA model is the level of anxiety from the portfolio manager, right? In terms of their need for execution. And then as we look to the bottom to help determine trader compensation, as I like to say to our team, there's not a whole lot of upside from a portfolio manager who says, well, I'd sell at these levels, right? And okay. So my downside is, well, I think the market's going higher. However, news comes out, a trade goes down lower and you miss that level. So it's that juxtaposition of the need to get the trade done and the thought of, well, if we'd like to sell in here, then we sell in here, right? I mean, that's I think that's difficult to add into a model, and that's maybe something Ravi can kind of speak to. And again, I keep harking back to times of volatility, and even during summer months when there's a lack of liquidity, right? Or holiday weeks or whatever the case may be. So maybe Ravi can kind of help get me over that hump a little bit.
So I sort of mirror those sentiments. I don't think that TCA should ever be used in determining trader compensation, especially when there's so much noise in the market data that we receive from fixed income, right? There's so much noise that it's so hard to find the signal. So when you find the signal, we really think that should be put towards sort of collaborative work with our trading desk to ensure best execution against our benchmarks.
And just, what, can you talk a little bit about the TCA systems you're presently using or thinking about using? What do those look like, given what people are wanting out of their TCA solution?
Yeah, so we, just as internal TCA in Vanguard, we generally build out all of our systems from scratch. So having as raw of market data as possible. Obviously in equities, that's an easy solution, right? You get your consolidated tape and you do your TCA. It's very simple. In fixed income, it's a lot more difficult. We have to sort of weigh the pros and cons of bringing in different data sources. There's a lot of players in sort of the market data markets right now. And we just, try out a bunch of vendors and see what sort of gives us marginal information gain above the current solutions that we have. So while we do build out most of our TCA in-house, we usually start with a vendor that gives us a general sense of things. So there are sort of, as Ravi obviously knows, there are all-encompassing solutions in TCA, which give you, they give you a handful of benchmarks, but we find that the most meaningful research comes when you can have the most granular market data, because when the questions start coming from the trading desk, you need as much data as possible to answer those sorts of things.
Yeah, and to Ross's point, I think the pre-trade data has increased exponentially over the past 5 to 7 years. It's no longer just, looking at Trace, looking at Bloomberg runs, things like that. There's easier access recently to kind of dealer inventory. We're starting to see an increase of information flow on actual dealer access, which is extremely different than just their inventory and line items that they're trying to move. And I think that needs to be that hopefully that continues to evolve as the pre-trade analytics will obviously help with eventually the post-trade analytics.
Yeah, I mean, obviously, what's nice about this panel is we've views from different perspectives, in terms of firms considering adoption, somebody using a proprietary system, and of course, third-party provider of TCA solutions. Maybe just, continuing on with this theme about important features and data, I'm curious about the data sources that are actually being used. I know we talked a little bit about this during our prep call, and as it turns out, there's actually a really interesting question that popped up too, talking about inaccuracies of certain data that we get in, like your timestamps for execution, or how do you analyze slippage, when this is sort of happening, considering the types of data you're trying to aggregate to make, to do a successful TCA type analysis. So just, throwing the question back again, types of data you're using, how do you deal with things like inaccurate timestamps and other challenges?
Yeah, I mean, I can maybe just to pick up on that as quickly, just in terms of like the integration of clients, data into any TCA engine is kind of, it's a big lift, right? It's a non-trivial exercise. Let's just call it that. And especially if you're covering kind of multi-assets from, fixed income, FX, equities, the quality of the data that we get in obviously will determine the quality of the output, right? Garbage in, garbage out does apply here. So we do spend like a lot of time just making sure that, we get kind of clients are coded up to the interface in the appropriate way, and we test it, and we can do things like, proof of concepts with clients just to get that part right. And it is kind of foundational, I think, as the question is alluding to, because if you get that wrong, or you don't get that quite right, then, all the hard work that comes afterwards is questionable. So it's definitely like probably one of the most important parts of the whole TCA process. Sorry, Ross, you were going to say?
Yeah, so just mirroring Ravi's sentiment, right? getting our internal traits data is, you can't do anything unless you make sure all your timestamps are correct when they come back. That's sort of what we see on our team as part of one of the mandates of a TCA team, is making sure that like all the fixed tags that come back from vendors and dealers are correct, and having systems in place to check those. Like Ravi said, right? It's all the work is meaningless if the timestamps aren't correct, and that's just one particular example. Another thing is, trade tagging, making sure that we can judge, portfolio trades from even algorithm trades and these sorts of things. So getting your internal data hygiene is again, it's table stakes for doing any sort of TCA work. As far as the vendors go, right, that's sort of the fun part, right? You get to sort of evaluate the different market data sources, see their pros and cons, see if there's any information, any marginal information you gain from those. So yeah, that's the unsexy stuff.
Yeah, the timestamp stuff in credit is a little more difficult. If you're working a larger order from IG to high yield, you may get a dealer that takes 5 to 10 million bonds off your hands, depending on the product, and then works that order through the day. And you start that order at 10 o'clock in the morning and finish it at 3 o'clock in the afternoon. You can see potential trades happening around block larger sizes that are trading. So that becomes a little more difficult. It's not an easy question to answer, especially on the credit side.
Interesting. Yeah, I mean, obviously, this talk about data coming in and out, and challenges with data inaccuracy. There's another question that we've received, and again, I'd like to encourage our listeners to continue to ask questions in the chat so we can answer those. And what this question asks is TCA relevant for fixed income voice trades, and particularly when things are not executed electronically, then you do have timestamp issues and perhaps other data inaccuracies, but how's that being dealt with?
Yeah, so that's a good question. We have sort of data hygiene practices in place on our trading desk. These things need to be booked within, X amount of minutes after the trade. You just have to sort of hope that that is happening for the most part, and we do see that it's, in some sense, we're responsible for our own data quality in that, in particular voice trades. Yeah, it's not an ideal situation. Obviously, you would want to have a computer-generated timestamp, but you do the best you can there. And in a lot of cases, for those voice trades, right, those ticks in any sort of market data that's available, those ticks are coming out every 15, 20 minutes. So it's if you're doing 3-5 minutes on either side, it's not crazy to look at those.
Interesting. I mean, Ravi, just a quick question for you. I mean, obviously, providers have to adapt to the many different protocols and ways of risk transfer that professionals are using. I mean, what do you see as kind of being some of the more salient points of adapting to evolving data and certainly the use of cost analysis?
I think, like, one key thing for us in terms of, we've recognized that clients will want to consume TCA in different ways, right? So there will be those that want to take the entire solution front to back, but then there's going to be many, like Ross, for example, in Vanguard, who will want to maybe consume parts of that solution. So, we've invested effort and time to kind of produce things like APIs as part of our offering, right? So last year we launched a post-trade API, and clients are using this today to capture data outside of the ecosystem from TCA and populate internal data lakes used for data science research, or commingle with other data sets to do kind of business intelligence. And so we're going to continue down that journey, and the next stop on that is kind of pre-trade and providing the pre-trade models that we have to our clients through APIs. So that's definitely been one big kind of shift on our side.
Yeah. And we definitely want to talk about pre-trade as our next topic, but our audience has been asking such excellent questions. I'd like to ask this one first before we kind of move into that next topic. There's a question here that reads, given the constraints of fixed income data discussed, what are the differences between metrics the panel has had success in deploying in the space as compared to equities? And of course, we have made some comparison to equities thus far. And what they're saying is there's clearly difficulties, but are there any opportunities in these differences? I thought that was an interesting question. I'll just open that to the panel to respond to.
Yeah, so I'll give you an example of something that we were working on yesterday. So in particular, this is markouts. So the concept of are we seeing toxicity? Is there market impact for a given trade? Obviously on the equity side, right, nanosecond markouts may happen at the nanosecond and microsecond level. We're sort of still in the fixed income space determining what is the most effective markout to look at. Is it, a couple hours on each side? Is it a couple days on each side? And this is something that our team has been looking into pretty heavily actually over the past few days. That's just one example.
Yeah, one thing that we've used internally is actually our model for portfolio trades. You can load a single trade into a portfolio trade type of model that we've built internally. Not me, of course, but my colleague. And using that to kind of quickly analyze who's best set up. Again, not to just go to the Bloomberg run screen, and no offense, Ravi, but do not just go to the Bloomberg run screen and say, oh, well, it looks like Goldman's a buyer of 5 million and Citi's a seller a point higher of 10 million. And hopefully we can get something done somewhere in between. There's a little deeper dive, again, like you would for a larger trade. You can use that on a single line item. And I don't think I answered the question earlier, but we're not currently using a TCA, but we are in talks with, with a third party provider. So we're currently using more internal models to determine the best place to potentially get a trade done.
Just to maybe give a bit of just answer that from a different lens, looking at it through pre-trade. So we have we have an established kind of pre-trade model in the equity space. It's been there for a long time. It's heavily used, and we kind of set ourselves a challenge 18 months ago to build something similar in the fixed income space, which obviously, as for reasons we discussed, is harder. But we tackle that. We develop something. It's now available, and we're now using that as kind of inputs into various different parts of the trading workflow. So, and how we do that is quite similar to how, for equities versus fixed income, in terms of integrating it into various parts of the trade lifecycle, where, traders are asking questions such as like, what's the estimated market impact for this order? And the answer to that question might determine whether they go down a manual path or, an automated or semi-automated path to actually fill that order. So we're kind of seeing some leverage in terms of the mechanics of the output on the pre-trade side and how we integrate it into the trading workflow.
In a separate study, I've just pulled up another chart talking about data sources for pre-trade, which was from the same study that I described earlier. But in a separate study, we observed that the highest amounts of data spend were actually broadly allocated to real-time data. Which I thought was interesting. Of course, that includes more than fixed income. But, I think it sounds like both real-time and pre-trade information is becoming more and more relevant in our markets. And you can see in the chart, for instance, that streaming dealer prices via a vendor solution was selected by about 60% of our participants as being the primary source of pre-trade pricing information. And that's followed by things by axes and runs. But then if you go the third bar down, I thought it was interesting that calls with dealers is still kind of standing out, which gels nicely with that question we got about, how do you handle voice trades and TCA. And then of course there's some other sources like streaming dealer prices that you get through your OMS or axes and other information. And then further down the list, things like ETF levels and bank APIs are further down, and EMS is sort of still in the early innings. Curious, just again, throwing this out to the panel. How is the goal to be more real-time or near time being realized by you? Is it necessary for your trading too, I should ask, because this is fixed income and equities, obviously it is, but curious where your thoughts are there.
My first thought is I'm shocked that 43% of people responded they get pre-trade information by calls with dealers. I didn't think there were that many salespeople that picked up the phones these days, but I digress. It's just, it's more electronically reported these days, right? In terms of potential axes or broader themes that desks may be seeing. I think going forward, we may see ETF levels and respective underlying pricing definitely tick up, especially as we see fixed income ETFs start to be more prolific in the market. But that number, some of the responses on these in this chart just surprised me a little bit.
We have actually kind of going back to this chart, there's another question here. And again, this audience has been doing fantastic, asking a lot of questions, which I love. What they ask is that there is a lot of focus on pre-trade analytics and liquidity aggregation and credit, resulting in more adoption of fixed income EMSs. So we actually recently did a study on fixed income EMSs, and there's a webinar out on that one too, which has been recorded and you can access. But what they're asking is, how does that fit in the entire fixed income TCA ecosystem? And I think that's kind of a challenging question, because we still are in those early innings of adoption. But maybe the better way to ask that is, what systems are kind of adding value in making trading costs more measurable, which is sort of the corollary to this gentleman's question.
I think in EMS, I think as EMSs proliferate, I think you're going to see an extremely amount of increased pre-trade data analytics. I think even if you start with just the simplification of not enough screen space to be able to look in so many different areas for potential
Mhm.
pre-trade data, I think the EMSs kind of harness that, and I think it will only increase to the effectiveness of better decision making.
Yeah, I think someone who kind of gets involved in kind of EMS building and designing EMS solutions, I think one of the challenges we have is obviously not to, flood the user with lots of extra data, right? I mean, you can keep adding columns and columns, but ultimately it's about kind of trying to synthesize all that information to provide, clear, actionable signals. And where it's not clear how that might work, then giving tools to the user so they can kind of put together the ingredients and create those signals themselves. But it is, it's definitely like the next step of the, I guess, the evolution in the EMS space is kind of bringing in all this, pre-trade decision making into the EMS to kind of help the outcome, right? To make sure the next trade or the next order is actually better than the previous one.
Fantastic. So I think we're going to probably use this opportunity now to kind of dig into our final topic of the webinar. And I can't believe that we've been plugging along now for over a half an hour. But this topic really deals with the rise of more fixed income data and availability in tandem with the development of advanced technology. So obviously, if you recently attended Fixed Income Leaders Summit or many of these other symposiums that are out there, there's a lot of information and talk about things like artificial intelligence and machine learning and large language models. And in our context, obviously, their impact on TCA and fixed income analytics. So you can see, for instance, in this infographic I've included, more data and analysis are transforming the front office, with over 60% of participants believing better data integration is a top priority. That's really come up a lot too, particularly with T+1 right around the corner. Certainly 56% of our interviewed buy-side firms are providing staff that have an education or a background that's tied to data analysis and methods, so more data scientists. But that middle statistic of more than 50%, I think it was 51 or 52% of buy-side firms have adopted or partially adopted artificial intelligence and machine learning advanced analysis is interesting and kind of where I want to focus for this next part of the discussion. One of the first questions I always like to ask in relation to AI or ML, or even now large language models that they're exploding in the conversation, is what are the actual solid use cases for advanced tech? And Ravi, I feel like you're really well positioned to talk a little bit about what you're seeing with your clients and where the interest is.
Sure. I mean, we as an organization, Bloomberg, have been using AI, ML techniques, various parts of the business for, well over a decade, especially in things like pricing, right? Predictive models to kind of try to predict the next trade. Or obviously the resurgence has now come, I guess, from these, huge leaps in these sort of generative pre-trained transformer models, right? These LLMs. We as an organization have kind of built our own kind of large language model from scratch called Bloomberg GPT. I should stress the first question I get asked is if it's a chatbot. It's not a chatbot, at least in its current form, but it's more of an ingredient model essentially that will be used to kind of power products and improve some of the existing kind of natural language capabilities we have today, such as search on the terminal, summarization, classification. One of the things you might start to see is natural language becoming an interface into API calls. So we have, for example, our own kind of query language called Bloomberg Query Language. If you pick it up the first time, you need to understand how to operate it, how to use it, what's the syntax. So what you might be able to do soon is kind of just say to it, give me the last price of Apple and the market cap, and it will basically return the syntax and the results. Right. It's still, I would say you still need the human operator there to kind of in the loop to kind of evaluate it for sure. But it can help in terms of just the education of learning educating yourself on how to actually use tools such as BQL.
Yeah, interesting. I mean, I remember when you had to use very specific syntax, and it's eye-opening to me that you can actually type in a sentence and consumable information is returned, or that's something that's coming on. I'm sorry, was that Tom? I think you were about to say something, or Ross?
I was about to say something. So yeah, we are always sort of on the lookout for new ways to apply AI and machine learning, right? We have a good group of people with backgrounds in computer science, mathematics, engineering, right? And we continue to hire, right? It's important for our firm to have that sort of quantitative background. But what we generally see is that any sort of AI and ML applications that we can think of, they may be useful, but where we like to focus more of our efforts is more sort of in the sort of core statistical analysis. We believe there are a bunch of questions about our trading that are sort of yes/no questions that can just be answered by sort of just the basic, statistical analysis. Get your data right and do the statistical analysis. We do generally also try out some machine learning and AI models in conjunction with that sort of traditional statistics approach. What we see is that we don't necessarily get a huge bump in predictability or efficiency in those AI and ML models, and we sort of it's the thing that you hear from everyone, right? There's less explainability of those models, so even if we get 0.5% improvement in our predictability, for us it's sort of more useful to be able to explain to the trading desk, these are the components that are affecting the model. You can sort of reason and think through this. So yeah, it's something that we have not found a great use for internally, but I would imagine that vendors, as they're coming out with new pricing solutions, right, it's going to be a big thing in that area. So we're going to continue to keep our ear to the ground, but it hasn't been super adopted, I guess, within our firm.
I would reiterate from a firm standpoint what Ross mentioned, but I do also want to talk about the quantitative side, especially on the ETF part of the business. I think you can definitely enhance processes, internally, with quantitative analysis. I don't think it's quite made its way over to the active side as of yet, but definitely on the ETF side. And I think that will continue to evolve, especially as the quantitative side actually starts to learn more or be more familiar with the fundamental side, right? I mean, you're going to hire a quantitative person that's got all of the number skills. Well, they could become really effective when they start to learn more about maybe the technical side of trading or just the credit world in general. I think that will only help evolve the quantitative side of fixed income credit and trading and credit analysis.
Yeah, I mean, in just kind of looking at TCA through a quantitative lens, and this is one of our questions as well. And again, thank you to this great audience for asking so many of them. Do you think that gels well with this idea of using TCA to be able to determine things like optimal execution platform, maybe even the protocol, the number of dealers to reach out to, trade size, liquidity score, like all these things that are really quantitatively assessed? And then I guess as the corollary to that, is that to be enhanced in some way by more advanced technology, maybe at some point? I'm curious I'll open that to the panel.
So yeah, all of those questions are something that our team has looked into, and that's something that we continue to monitor on our side, right? Those are sort of what you said are sort of the big questions, at least in an RFQ context, right? Those are the big questions that a trader might have about optimal execution. So naturally, that's the place that our team starts when we do our analysis.
I think you can, just to pick on that, you can answer some of these questions today just doing simple stats, right? Looking back at your trading history with your brokers in certain sectors, looking at slippage, hit ratio, quit ratios, and and getting comfortable with that. That's a good starting point, right? And that's available today. And then from that, you can kind of start to think about layering on top some kind of, predictive model. But there is already a lot of data out there today. And I think you see clients who are comfortable in using that start to kind of integrate those data sets into automation and let the machine kind of take care of orders, up to certain sizes where they're comfortable. But definitely you can achieve a lot, as Russ was saying, with just kind of like some good old fashioned, statistical analysis.
Yeah, I think the question we're going to continue to run into with the TCA is, how does TCA bring into consideration other things that are going on in the market, right? I mean, when you sat through the regional bank volatility, how can we potentially encompass that type of information into execution? It's because the ripple effect can go so deep. It starts with regionals. Well, obviously the larger fins are going to be wider as well. How will my execution be evaluated, and how will those outside factors be brought in? I just think that's going to be the biggest question that people have for TCA and credit.
Well, I mean, and this is me asking the question. So if I was in the audience, I would ask this, and I don't know the answer, honestly. And I have a bit of a risk background as well. And when we're thinking through risk, we usually develop shocks and try to think about how that works through the market over a number of days. I mean, is anyone able to do that with pre-trade analytics now, or thinking about it? Or maybe that's just, because of the environment we're in, where it seems like there's something happening every other week at times, just something that's being considered.
Yeah, so it's definitely being considered on our side. Just like you mentioned, Audrey, right? It's sort of like how you form the risk models. You sort of see, how much does it blow out certain numbers when there's given volatility in the markets. As you mentioned, right, we need a good sort of catalog of those events to get a good idea of how that's happened, at least from a TCA context. So we have an okay catalog, but obviously you can never predict these things perfectly, and everyone is different. But it's something that we look at, certainly.
I mean, as I kind of said at the start, one tool is just looking at the peer analysis. So looking back historically at like those particular events, and then looking at the overall contextualizing against all peer data within certain sectors to see what happened to transaction costs over that particular time. I mean, we've got a fair amount of data from clients, and we're starting to now push some of that out in a kind of aggregated fashion to kind of allow clients to track execution cost. So our colleagues in BI, Bloomberg Industries, are now using some of this data to kind of generate new stories about fixed income and equity transaction costs, and how that is changing with kind of broader market sentiment and so that's starting to get socialized a bit more, and again, another way to kind of look at the data.
I can't believe it, but we've gone through 45 minutes quite quickly, and I know there were a few other unanswered questions that certainly we'll be in touch with you about. Again, audience participation for this webinar was fantastic. I've never gotten so many questions, so that speaks to obviously the expertise of our very good panelists, who I want to just take a moment to thank again for joining us for this talk. And again, if anyone is interested, this is being recorded, so you will be having the opportunity to see it again. I just want to thank you for joining us today.
Thank you.
Thank you very much.
Thank you, everybody.